Good morning, everybody, and a very happy Thursday to you. I'm going to hold here for just a second while we allow everybody to join our presentation this morning. Thank you so much for joining us. Like I said, going to get started here in just one second as I've got a bunch of people hopping into our webinar here. So hopefully everybody can see my screen already. At least that's the hope here. According to what I got, you can. So that's the good news. So before I jump in, quick disclosures for everyone before we get started. Today's presentation is for informational purposes only. It is not personal tax or legal advice. Everyone's situation is unique, so please consult with your tax advisor or attorney before making any changes based on what you hear today. Also, keep in mind that while we'll talk about this new law's provisions and even some forward-looking language, actual outcomes can and will vary. And past performance or past laws don't guarantee future results, and tax laws can change in the future. So, in short, don't make any moves solely based on this presentation. Make sure you talk with your advisors to tailor any actions to your particular circumstances. So, let's go ahead and get started as it looks like we've got everybody basically joined here. So, thank you again. This is a special edition of our Coffee with FourThought. We'll call it our breaking news edition. Obviously, after we did our presentation last week, the day after we had the One Big Beautiful sign into law, and we thought rather than waiting for another month to bring that news to our clients and folks that we want to be talking this over with, we would do a special edition today. And so we're going to talk over what has changed and maybe more importantly, what has not. For those of you who do not know me, my name is Joel Johnson. I am a financial planner here with FourThought, specifically on our signature team. And unfortunately, I am a very large self-proclaimed nerd. And so when things like this come out, I end up diving in, doing as much research as I can. That way we can hopefully consolidate it down and bring it to you and make it actionable for things that might help you in your particular planning situation. Now, before we dive in, just a quick note, we do have Q&A open. I am going to do my best to keep this to about a half an hour. And so if we don't get to your question, rest assured we will have it, and we will have one of our team reach out to answer that question for you if I am not able to get to it during today's session. Words of warning. I am very well aware that this can be a very politically charged conversation. So I want to make it clear that we are going to be discussing this bill in terms of its content and not at all about the politics. So some of you are going to love some of the certain things we talk about. The other half of you are going to feel the complete opposite about it. Just know that my role here is to distill down what I've been able to gather and bring it to you in an unbiased way. Two, the name of this bill is actually the One Big Beautiful Bill. So it is not an endorsement one way or the other of anything that I talk about today. Just as an example, you'll remember quite a few years ago, we had what was called Obamacare. That wasn't the actual name of that bill. That was actually the ACA bill or the Affordable Care Act, but then they nicknamed it with the moniker Obamacare. That is not the case here. This was actually called One Big Beautiful Bill. So any reference to it, just know I'm referencing the bill. Third, permanent is actually temporary. So a lot of what I'm going to talk about today, I might use the terminology permanent, but as we know, tax laws change over time. So it's only as permanent as Congress allows it to be. And then fourth, we're talking about tax. It's Thursday morning. I'm hoping your coffee has kicked in. If it hasn't, like I said, I'm going to try to keep this to about a half an hour, and I'm going to try to make it as fun as possible. But we are talking about tax law here. So just bear with us as we get through it. And I'm going to be happy to answer any questions as I can along the way. So where are we going to go today? I want to give a brief background on where we have been since 2017. Then really focus most of my time today on the things that I think are going to most impact individuals in their individual planning. I'll touch very briefly on planning for businesses because this certainly did have an impact on business owners as well. And then some miscellaneous items of note towards the end. And I'm going to finish off today with some action items and steps that I think you should take after today to maybe put some of this in place for you in your particular situation. So, with all of that being said, let's jump right into it. So where have we been? Well, since 2017, we had the TCJA, Tax Cuts and Jobs Act. That has been the law of the land since, and was set to expire at the end of this calendar year. So when they were looking to pass that law in Congress way back when, because of how that bill had to be scored to get through Congress, they had to put provisions in there, which most of which would sunset at the end of this year. We would revert back to where we were prior to the TCJA being in place. What did the Tax Cuts and Jobs Act actually do? The primary things, the key provisions you see listed there on that slide, it adjusted marginal rates down for most individuals, increased our standard deduction, introduced and improved the child tax credits, limited SALT deductions, and it also limited mortgage interest deduction. And so what this one big beautiful bill did was essentially take all of what had occurred back in 2017 and made it again, quote unquote, permanent. And we're going to dive into what those changes were. So most impactfully for the most individuals was around income rates, ordinary income rates, and the standard deduction. So where we have been for the last 8 or so years is now going to be the same moving forward. They kept our tax brackets the same. And you see on the right side of the screen there, I have the current tax brackets for individuals married filing jointly and separately and single on the right-hand side there. Those bracket rates are going to stay the same moving forward. And again, that is now quote unquote permanent. This was scheduled to sunset at the end of this year, at which point most of those middle brackets you see there would have increased by about 1 to 4%. And it also would have increased the highest marginal rate as well. So this is now where we're going to be for the foreseeable future. And interestingly enough, what this also did was give a slight bump to those lower brackets. So everything 22% and below is going to get an additional cost of living adjustment. That's what you see COLA there. It's going to have an additional bump in 2026. It's just a one-time, and then we go back to our regular inflation adjustments moving forward. So that was an interesting little tidbit that they threw in there, something to be aware of. And for individuals, what that's going to mean is for everybody, more of your income is going to be taxed at those lower rates. Remember, we are in a marginal rate system, so you see the income thresholds for each of those. So those are going to go up in 2026, but these are the rates that we're going to have moving forward. Additionally, we also now have an increased standard deduction. So we made permanent the essential doubling in size of the standard deduction from 2016. That increased with the TCJA. That is now also permanent. It did also come with a very slight bump. And so you see I have that listed there, and that is going to be for 2025. So that's taking effect in this year. So maybe some planning opportunity. It's not a massive bump for individuals there, but it is some. And so there might be something you can do there. Certainly something to note for everybody. Increased standard deductions. And again, this is also permanent moving forward. A quick note while we're on this, but it won't apply to most folks, so I'm not going to spend too much time on it. They did also make some changes to the alternative minimum tax, the AMT rates, and the phase outs. Again, it doesn't apply to everybody, but if I said those words and you understand what they meant, you certainly have some new planning opportunities as well. So reach out to either your tax professional or your advisor, and they're happy to walk through those specifics with you. Moving right along and sticking with deductions. So going from the standard deduction to other deductions that were introduced into this bill. So in 2017, we had limited the SALT, the state and local tax deduction, for those folks who it applied to. So think of large income tax states. And we capped that at $10,000 for those individuals for the last 8 or so years. What happened with the passing of this bill is that was actually increased up to $40,000. Okay, and that does take effect again. I believe that one is also this year. I'm sorry, I don't believe that one is this year. So it jumps to $40,000, but there are going to be income phase outs there. So if you are still a high income earner in those states, it starts at about $500,000 worth of income. You phase that out from 40,000 back down, but you do have a new the same floor that we had, which is the $10,000. So if you are somebody who is subject to state and local tax, certainly some planning to do around here. What this bill did not do that was in some of the prior proposals was restrict some of the workarounds that some states had placed on this particular deduction. So some states allowed people to create what's essentially a business entity to pass the state and local tax deduction through. Certainly not an expert. I'm an advisor in Florida, but some of the proposals did have some restrictions in there for what folks could do with that. That did not end up in the final bill. So increased state and local tax deduction. Be careful of those income phase outs. Some planning to do for some folks there. Seniors, you get a potential bonus deduction for this year moving and for the next few years. So this only goes until 2028, starts this year until 2028, an additional $6,000 deduction for those aged 65 or older. There are also income phase outs here, so you want to be aware of those. And I think some of you probably received an email from the Social Security Administration. I know I did, which was odd, but essentially they came out and said this was great. We're helping seniors with Social Security. Nothing in the One Big Beautiful bill directly affected Social Security. What it did do, what they were referencing is essentially this new deduction that seniors have. So if you are a relatively low income earner, again, you got to keep an eye out for those phase outs. You do now have access to this, which would help with the taxability of Social Security, but Social Security benefits were not directly affected by this bill. There are 3 new deductions for 2025 until 2028. You will hear these commonly referred to as the no tax on tips. That does not mean all tips, so that's a little misleading. There is a cap to how much of your tips you are able to exclude. It's fairly straightforward on how all of that works, but again, it's still subject to income phase out, so you want to be careful there. But if you do work in a business where regular part of that business is tip income, there is now the ability to deduct some of that from your income tax for the next few years. Similarly on overtime. So again, income phase outs to be aware of, but for the next few years, overtime for any regular ongoing work, you also get a new deduction there. So that can certainly help some folks where that applies. Very straightforward definition on overtime. We're going to get a lot more clarity on how that's actually defined over the next couple of weeks here from the IRS and such. But be aware of it if that is part of your regular compensation. Have a conversation with somebody about it because you may now be able to get to deduct that for until 2028. The final one, which is a little interesting, was there is now a deduction for car loan interest, again, only until 2028. And again, it does have income phase outs. This one's a little bit more interesting because it has to be a brand new car and the car must be finally assembled in the United States. That's very high level what you're looking at there, but you cannot buy used cars. They do have to be new and it has to be finally assembled in the United States. So we're going to get a lot more there on which cars qualify and such, but it's something to be to know about just very generally. I would not just go buy a new car for this deduction. You should never do things just for the tax benefits, but you should look at it. So if you were planning on going to get a new car and you were planning on financing it anyway, you may now qualify for this new deduction. We did make permanent the limit on home mortgage interest, so that cap remained at $750,000 of mortgage balance. The interest on those mortgages, that cap remained the same. This was a little interesting. They had talked a little bit about maybe raising this. The reason that it matters is most folks are aware that housing prices have really increased and so have interest rates. So having a higher deduction limit might be very, very helpful for a lot of folks as we kind of see folks starting to move around in the real estate market. That one did not change, so it's something to know. The one slight change they did make, if it does apply to you, is that now some private mortgage insurance could also qualify towards this. So be aware of that, but that one was now made permanent. Charitable deductions for non-itemizers. So in the past, if you itemized your deductions, you were able to take a charitable deduction as part of that addition towards, and anything above your standard deduction would qualify, right? They've changed that now. So even if you do take the standard deduction, you are able to have a small amount of charitable deduction count as well. If I remember correctly, it's $1,000 per individual, $2,000 per couple. I do believe that the restriction is it has to be a cash gift to a 501c3, cannot be a donor advised fund. But again, we're going to get more clarity on that, but something to be aware of if you are taking the standard deduction, start keeping track of those receipts. For those who are taking the itemized deduction route and you're including charity in that, there is now a floor. It's very small, but it's something to be aware of. It's 0.5% of your adjusted gross income now no longer qualifies for that charitable deduction. Everything above that does. So very low floor, shouldn't really impact you too much, but it is something to be aware of that is now out there. For my financial advisor, CPA, and attorney friends, miscellaneous itemized deductions are still not allowed. So advisor fees are still not deductible. That is now made permanent moving forward. We've been under that since the Tax Cuts and Jobs Act, so no change there, now made permanent. And again, just for my working colleagues out there, moving expenses, those remain non-deductible as well. That is now also made permanent. So lots of things happening on the deduction landscape, a lot of planning opportunity here. So if any of this applies to you, highly recommend you reach out and talk about this with either your advisor, your CPA, or an attorney. Okay, so moving from deductions right into child tax credit. Fairly straightforward on this one, but the base amount for the child tax credit went from $2,000 up to $2,200. So that is going to be for this year. They did make some other ancillary changes to this, but the big one is we did get a slight bump, and this is now also made quote unquote permanent. There were quite a bit of language in the bill regarding other benefits to incentivize large employers to help provide more child care to families. I would put that in the context of trying to encourage those employers to make that more a part of their regular business. It kind of goes beyond the scope of what I'm trying to get to today, but just know that that was in there. We might start seeing some employers start to offer some of those benefits, but that will all come with time and we'll just have to see. The big one, I think, for this slide is that we do get that bump. The other real big one that we've been kind of watching for was on the estate and gift tax exemption. So this was also kind of solidified and codified. So in the Tax Cuts and Jobs Act, we virtually doubled the amount of estate exemption that any individual person could have. We've been increasing that with inflation. And again, that was set to sunset at the end of this year, and it would revert back to where we were. They did make this now permanent. They did give it a slight bump as well. So in 2025, that number will jump to 15 million per person, 30 million per couple, and that'll be indexed for inflation moving forward. Just to give you an idea, this year we're at just under 14 million per person. So it's a slightly more than inflation adjustment for 2025, but this is now set to be permanent moving forward. So again, permanent is always temporary, but that was good news for the folks that it applied to, and something certainly to be aware of. This bill did not change the rates for any estate or gift taxes. So just be aware of that. It increased the exemptions, but from what I can tell, the rates of all of that were not changed. There was some conversation out there about maybe increasing it. It's already a relatively high rate, so no changes to the actual rates, just to the exemption there. Okay, so moving on to education accounts. We expanded the 529 plan usability. This is good news for clients. We have conversations all the time about how should I save for my child's future. And one of the big drawbacks to 529s that a lot of people kind of perceive is that if the child doesn't go to college or use it for qualified education expenses, then the money it's not trapped, but you're going to get taxed on it. And so that was always a drawback. So they continue to expand the usages of the 529 plans. The first one there, post-secondary credentialing programs are now recognized as a qualified expense. That is good news for someone like me who wants an alphabet soup after their name. Now I can use 529 plans to do that. Certainly something to be aware of for those CPAs and other folks out there as well. That's good news for us. But additionally, they expanded the K through 12 expenses that qualify, as well as any homeschooling costs could now also qualify. So just be aware, 529 plans, they continue to expand what those might look like. and how you can use those funds moving forward. That is all good news. And this just adds to what we had with Secure 2.0. So good news there. Again, this is apolitical. They are calling this the Trump accounts. Okay, so you've been hearing about this. These are now an option. These are now out there. So these Trump accounts, as they're so called, for children, this is a new type of account that folks can open up for their children once they are born. You're able to contribute up to $5,000 in after-tax contributions. That'll be indexed. The government will actually make a $1,000 contribution to these for any children that are born this year or until 2028. So it's a relatively short window there, but the government will actually contribute to these, which is interesting. And then uses once they reach certain age thresholds, starting at 18 or education, you can use it for small businesses, and you can also use them for first-time home purchases. Now, the taxability of these are a little weird. If you use it for a qualified purchases, from what it sounded like, from what I've read, it's going to be taxed at long-term capital gains rates in the future rather than ordinary income. Certainly better, but still not great. So outside of the $1,000 seed from the government when the child is born and the account is open, I'm curious to see how these are used just right off the bat. And again, we're going to do more research on this, but right off the bat, I don't think these quite outweigh the benefits of 529s and other types of accounts. But that'll be remain to be seen as we kind of look at what guidance comes out from the IRS and as we really dive into how these are actually going to be implemented. The one good thing about these is that the account will be invested in an index, so perceivably the S&P 500, but again, we'll see. But once you open this account, that $1,000 that it'll be seeded with, that'll be in the S&P 500 or another like index, and it will grow for your child over the next 18 to 30 years. Great. Again, whether or not this is something that a lot of folks start to take advantage of, we'll kind of wait and see. But it's there, and if this actually does, or this is now law, so certainly at least take advantage of the $1,000. The final one here, just a quick side note, student loan forgiveness will continue to be excluded from income moving forward. Again, it doesn't apply to a whole lot of folks, so I'm not going to spend too much time on it here. But there was some worry. Any loan forgiveness can, most of the time, it'll be included as income. They did continue to exclude student loan forgiveness from that. So that is good news for those who it applies to. Okay, very quickly for my business owners out there. So these are my small business owners, not my large C Corp business owners. I'm not talking to the CEOs of the S&P 500 here. But the QBI deduction, the qualified business income deduction, that has now been made permanent. They did extend the phase outs and who qualifies for this. They did also open it up to actually having more people qualify for it, which is good news, but they did not change the type of businesses that qualify for it. So my financial advisor friends out there, my CPAs and my attorneys are rather disheartened by that. There was some conversation about opening that up, but special services trades, that still applies. So bad news there. And additionally, in the original proposals of a lot of this bill, they had talked about taking that deduction from what is now 20% up to 23. That did not make it through. We kept it at the 20%. And again, there is some planning opportunity here now for my small business owners. It's more marginal, I think, but it is certainly something that you're going to want to reach out and talk about with your professionals to make sure that you are on track with all of the changes that just happened with the QBI deduction. But the QBI deduction moving forward, locked in and permanent. The other thing here, and I kind of put it under one broad bucket, is that they did put a lot of language into this bill about businesses making investments in the economy. I'm not going to dig into all of them. It's an 800-page bill. A good portion of that included these new incentives for business owners, but a lot of you're able to realize things as expenses, a lot of the depreciation, all of that we've been living under, again, made permanent moving forward. So great news there. Again, if this applies to you, might be some planning opportunities. Highly encourage you to reach out to somebody and talk about that and see what applies to you specifically, rather than me spending the remaining 6 minutes that I have talking through each of those individually. This one has been all over the news, so I don't think it'll be quite a shock to folks, but many of the energy and environmental items and credits that were put in place, mostly from the Inflation Reduction Act, those are now going to be rolled back and in fact eliminated. So the The electric vehicle credit that was expected to continue going, that is now going to be terminated for any vehicles acquired after September. If you were planning on buying an electric vehicle, you now have a window to get that credit. Again, do not make large purchases for tax benefits. That is certainly not how you should spend your money. But if you were planning on getting a new car anyway, something to be aware of. I know that I got an email from Tesla the other day warning me about it. This is exactly what they were talking about. Residential clean energy credits. So if you were planning on putting solar panels on your home, that credit is also going to be ending at the end of this calendar year. So any systems put in place after December 31st will no longer qualify for this credit. The interesting thing here is in the past, if you took advantage of this credit, you weren't able to use it. You were able to roll it forward into future tax years. Now, we thought that we had plenty of time to use up that credit. I'm not so sure that we will or not. It seems from what I could find already, and again, I would highly recommend you get with a CPA or an attorney on this. But it looks like if you have that roll forward credit, it'll continue to be able to be roll forward after 2025. Please, please, please double check that. We're going to get a lot more guidance, I'm sure, from the IRS and other folks on that. Something to be aware of. But any new systems after 2025 will no longer apply for new credits moving forward. So something there. And then everything regarding EV chargers, home energy efficiency credits, all of those miscellaneous credits that were in place, all of those are also going to be ending at the end of this calendar year. So a lot of that getting rolled back, and that'll have an impact in 2026 moving forward. Okay, some other items to note here. The bill does not help with the debt problems in the US. This is a conversation we continue to have with clients. This certainly was not a spending cut bill. There were some portions of it that were in that direction. But at the end of the day, this does increase the debt limit for the United States. So we are not making progress towards fixing that problem. I don't know if there are going to be fixes to it. That's a completely different conversation for a completely different day. But this bill in particular does not help with that. Number two, opportunity zones. This was an opportunity. Well, there you go. An opportunity zone is an opportunity. But this was a type of investment that people could take advantage of since 2017. They've actually expanded that, and this is going to be a moving forward, something that people are going to be taking advantage of. There was a plan for these to stop. This was one of those things that were going to sunset. The investment opportunity there was going to sunset. That's no longer going to happen. So now it's going to be a rolling opportunity zones. They've expanded it a little bit, very detailed on how all of that works. If you're in opportunity zones, this is great news. If this is something you thought about taking advantage of, it's great news. And I think it's really going to help our lower income communities. That's the idea of it, at least. And so having this as a permanent part of the law should theoretically help moving forward. And again, encourage you, if that rings true to you, reach out and we'll talk about the specifics there. And then also for qualified small business stock gains, again, it doesn't apply to a whole lot of folks here, but I think it's important to note that they did expand what those benefits are. They increased some of the limits there. So if you do own a small business, this is a new planning opportunity, or at least an expanded planning opportunity that we might be able to take advantage of in the future. So great news there as well for my small business owners out there. All right, so what are your next steps? So again, this was an extremely high-level overview of an 800-page bill, and I would not encourage you to try to go to read it. It's 800 pages of tax law. It's a lot. So, so what I would encourage everybody on this call to do is give us a call. Let's talk through your individual situation, see what planning opportunities have opened up because of these changes or lock-ins of existing law and the minor changes that we've seen. We need to review your plans, see what things have either opened up, changed, or if we need to make any pivots one direction or another. And certainly one of the things that we always do here at FourThought is coordinate with your other outside advisors, your CPAs and your attorneys, making sure that they're aware of what we're talking with you about and making sure that they agree with any of the things that we're discussing with you. And please know that we are here to help as we explore this new tax law as it goes into place. And thank you so much for joining me today. I really do hope that this was helpful. I'm grateful that we now know what the rules are. This is now the law of the land for the foreseeable future. And so we're able to start really planning for our clients around that and making sure that we are doing everything that we can for you and for your families to continue to reach those long-term goals. So thank you so much for joining me today. If you have any questions, please feel free to give us a call. I hit 30 minutes right on the nose there, so that's great news. It doesn't look like I have any questions in my chat box here, so I will let you all get back to your Thursday. Thank you again, and I look forward to talking to you all again at our next Coffee with FourThought. Have a great day.